Buying the top, selling the bottom, the infinite conundrum for day traders. So what does it really mean to buy low and sell high? I mean, that's such a subjective, wishy-washy terminology that helps no one. Let's explore. Is there something that you can use to work out with a reasonable amount of confidence whether a price has gone too low or too high for that day, making your entire position, if you want to go in the same direction, a lot riskier than it should be? So if that's something you want to learn, then keep watching. Hey everyone, welcome back to the channel. My name is Dee and this is Market Stalkers. As you've already noticed from the intro, today's video will be about showing you my way of avoiding those silly trading mistakes, such as buying the top and selling the bottom. If you want to see more videos like these, then please click on the subscribe. And if you don't want to miss when I upload new videos, then also please switch on all notifications. That way, as soon as I upload, you will see my face pop up on your phone, on your computer, in your kitchen, bedroom, man cave. But jokes aside, today I'll talk about how you can use average daily ranges to ensure a better timing on your trades and to ensure that you still have enough space left on the day before the price sort of runs away in one direction too much. As always, I like to turn to some rather simple stats about the market behavior itself. The way that I do that is by looking at how much the price moved for, let's say, about 10 to 14 trading days. Now that's about 2-3 weeks worth of moves, right? What you're going to find is that the markets, they won't really have that much variation in the number of points or ticks or pips or whatever you want to call the minimum price movements. Instead, it's going to have a certain expected range on most days. And because of that, using something like an average of those 10 to 14 days will give you a pretty decent idea of whether the price has gone too high or too low for the day. Pretty simple, right? Now, when people first start trading, they usually expect the market to just kind of keep going in one direction for an entire day. But that's not what happens. And it's certainly not the norm. Even highly liquid stocks, they don't really go shooting up or jumping off a cliff all in one single direction. Instead, a normal trading day will have a very predictable ebb and flow. I teach you how to capitalize on this observation of mine in levels 2 and 3 of the Pro Development Program in great depth and great detail. And the thing that I'm explaining here is probably my oldest technique that I've been using since the beginning of my own trading journey. So that's now like well over a decade of trading. Even when I was just a swing trader back in sort of 2009-10, I still use this technique to time my entries a bit better. And it's also a technique that saved my butt when I first went into day trading futures at a prop firm. And you know, we've got some new people on here, new subscribers, and you know, some of you might think that I'm just a kid in my 20s, but I'm actually in my 40s and I started trading. Well, I first started trading in 2007, or kind of dabbling, but a little bit more seriously since 2008. Since then, I've been staring at the charts and tracking my progress very methodically, which is why I've been able to get a pretty good grip on the trading craft and to raise my skills to the professional level, where you know, you're aware of the quality of the trading setups you're taking. So let's get into it. First up, let's go over how you apply and calculate the average daily ranges, because I've noticed that on some platforms there are a lot of custom ADR indicators that have the wrong calculations. Now, finding the mean average number is very easy. You take the number of days, so either 10, 15 or even 20 days range, add them up and then divide by the number of days you selected. Now, this next part is where things kind of go wrong. Applying the mean average number. So where do you calculate it from? Now, I've seen a lot of ADR indicators that just start the calculation from the daily candle start. So they go midnight open plus 120 ticks, that's my ADR high, and midnight open minus 120 ticks, that's my ADR low. But this is wrong. I have no idea what this calculation is, but that is not the average daily exhaustion level. What you're going to get with that kind of an approach is only going to get reached when you have some kind of an abnormal rare trending day. So why do I say abnormal and rare? Well, you remember just a minute ago I said how the markets usually don't go shooting up or down in a straight line, but that on most days there will be a lot of waving up and down, sometimes in these like very sharp sort of pendulum swing reversals. Well, you know, single direction days, they do happen, but they really happen only about 30% of the time when you look at the entire year's worth of intraday price behaviors, and that's on instruments that tend to kind of trend quite a lot. Some of the other instruments, especially like forex and stuff, it's actually a lot less than 30%. You know, those days where the market just opens and it just keeps going. If every day was like that, trading would be like super easy. You wouldn't need any skill. And in fact, people who have made money in markets like that, typically their skills are not quite there because they don't really realize the quality of the setup. Calm seas don't make good sailors, and you know, it's exactly the same for trading. When it comes to ADR indicators, you should always be a bit suspicious when someone claims that their indicator is an average range of something, and yet that average range never actually gets reached. So it's not that average, is it? In order to make consistent income from day trading, we need to trade events that happen nearly every day and sometimes even 2 or 3 times a day. If you start relying on trading events that only happen 30% of the entire year, you'll only get your setups on about, what, 60 days? And I'm not talking about consecutive days. Now that's a lot of waiting around. So how do you apply the average daily range? You don't calculate it from the daily candle start. That's for sure. You calculate it dynamically from wherever the current day's low is or current day's high, and then plus or minus the mean average range that you had from the earlier calculation. So whenever during the course of the 24 hours you get a move that goes either from the day's low plus ADR or the day's high minus ADR, that means that the average range has been exceeded for the day. Now this means that you have to dynamically track whenever the price makes a new higher high or a new lower low on the day until one of those sides gets exceeded. Now let's talk about how to apply that to your trading positions and trading strategies. The first application would be for better trade location. If you're looking to buy to go long, the best timing for a long trade would be to wait for a day when the market is falling, but on some larger time frames it is in an uptrend. And then once the ADR low gets reached, so the market falls, exhausts that whole average daily range to the downside, then you would look for signs of a reversal or some kind of a slowdown at the very least. Statistically, this would give you the highest profit margin on the day for a buying the dip strategy. If on the other hand you have a day where the prices started going up and you're looking to get in on that move, making sure that there's enough of this average daily range left on the day would mean that you're not at risk of buying the top, because you know where the ADR high price is, and that's where the ADR range, the statistical range, is going to get exceeded. So a safer strategy would be to maybe take profits there and not to buy when it gets there. So just by using this simple piece of statistical data, you can ensure that you either improve the timing of your trades or that you have enough statistical space left for your profit margin. Now, if you are based in Australia or in Asia, because I know that we have people from there, using the entire average daily range may not be the best strategy for the sessions that you trade, because average daily range over a whole 24 hours, it works best for the New York session, simply because most brokers start the daily candle calculation from GMT midnight. So if you get a day where the entire ADR gets exceeded already during Tokyo or London sessions, this actually implies an unusual day. Something weird has happened. It's not normal for the entire day's range to get exhausted during those sessions. But that's an entirely different use of ADR. Either way, if you are based in Australasia somewhere, you might be better off just using my own concept of average session ranges. So instead of looking at the entire 24-hour average, you focus on the session range for your chosen exchange hours. Now, obviously that's a little bit trickier, and to help people with automating all this, and to help me with automating this, I actually asked my technology team to create an indicator that dynamically tracks these levels for you, so that you don't have to bother with these calculations yourself. We created Blahtech DR that also includes the average session ranges. And just like the average daily ranges, The indicator would dynamically track new session highs or new session lows until it tells you which side is finally exceeded for the day, giving rise for some kind of a reversal or mean reversion trade. There are quite a few more uses for these average ranges, not just for trade locations or timing. So if you wish to learn how I pair all of this up with my other concepts of market profile, supply and demand, and quite a few other proprietary things that I've got going on, then you might want to click on the link below to take our interactive assessment quiz that will take you to the appropriate membership page for your current skill level. Until then, thank you for watching, liking and subscribing, and I'll see you guys next time.